Hi guys, so today we're going to be covering chapter 3, which is all about audit planning, types of tests, and materiality. This is a quick overview of the chapter, and I just want to point out that the really tough part of this chapter is going to be down here when we get to the materiality topics. These three, the client acceptance and continuance, preliminary engagement activities, planning the audit, and types of tests, are pretty easy. They're more of a just, I need to push through these and memorize them type of thing, whereas materiality is kind of tough conceptually. So we start off talking about client acceptance and continuance. So quick definition, client acceptance is if I'm accepting a new client that I have never had before. Client continuance is if I've had this client in prior years and I'm deciding, hey, do I want to work with this person again, this firm again in the coming years? This slide is about procedures for evaluating a prospective client. So this means the client is not currently someone you're working with. This would be a brand new firm that you're auditing. And basically, if you read through these procedures, you'll notice a common theme, which is we're trying to figure out how risky this client will be. Right? So a lot of this stuff is about trying to interview third parties to figure out if there are concerns with management's integrity, trying to consider if this client exposes you to litigation risk, or if the client has bankruptcy risk. So all of these things are determining how risky the audit will be, both in terms of, hey, is this going to potentially expose me, the auditor, to having audit failures, which happen when the client's financial statements are misstated and I give an unqualified opinion saying they're okay. And then we have to restate the financial statements. So that's considered an audit failure. So if there's anything about the financial statements that makes me think I may not be able to do a good job with auditing them, then that would be a concern. Again, if there's something that exposes the company to litigation, it could potentially also expose me to litigation as an auditor. So I want to understand those things. If the client's going bankrupt, one, they might not be able to pay me. Two, a really common thing with the going concern opinion is if I give the going concern opinion, firm might fire me because they don't like it. If I don't give the going concern opinion and firm goes bankrupt, the shareholders can sue me because I have deep pockets, remember, as the auditor. Okay, so for number 4 and number 6, these two are related. They're basically saying, hey, you want to make sure that nothing about this client is going to cause you to break the code of conduct. So that includes making sure you're independent of this entity. 5 is making sure you have the necessary technical skills and knowledge. I would say this is not a deal breaker if it's something you don't have, because you can always potentially hire in a new partner or new manager that has that expertise. So it's not necessarily a deal breaker, but if you don't have the expertise in-house, you need to seriously think about where you're going to get it from and how realistic is it that you'll get it. The new audit firm or successor audit firm and the old audit firm or predecessor audit firm need to have some communications happening before the new audit firm will be willing to accept audit. So basically, they're going to ask them questions about the client, their experience with the client, and the predecessor firm should allow us to look, as the new auditor, to look at their work papers and give us some information about the client. Now, you'll notice this says only with client permission, because as we talked about, client information is confidential. So you don't want to just go around sharing client information willy-nilly with anyone who says, oh, I'm the new auditor. So you need to expressly get the client permission to share that information with this possible new auditor. And as a new auditor coming in, if the old audit firm says that they can't share the information with you because the client doesn't want them to, doesn't want the information shared, that is a huge red flag, right? Because what exactly are they trying to hide there? Is there some kind of fraud and that's why they're moving on from the old auditor to the new auditor and they're trying to hide that? So this is definitely something that would be a huge red flag and would mean that you probably shouldn't take on the audit. This slide is actually just summarizing what I just talked about. Basically, we know they need the client permission to share the information. If they don't want to give it to you, that's a big red flag. So you would not want to accept that client. And these are some other things that the new auditor wants to talk with the old auditor about. So anything that would give insights into management's integrity, also any disagreements that they had, that the old auditor had with management. Like, did they disagree over significant accounting policies? Did they disagree over these big estimates management has on the financial statements? Also, you want to understand if there's been any fraud or non-compliance with laws, because obviously, again, that is a huge red flag, and that is something that would expose you as the new auditor to a lot of risk, right? It's opening you up to risk of damaging your reputation. It's opening you up to litigation risk from potential lawsuits. So you want to make sure that you're all squared away. And basically what happens is, as an auditor, you are going to accept some clients that are a little bit more risky, but you want to manage what is known as your risk portfolio, right? I don't want all my clients to be super risky. I want most of them to be medium or low risk. And then if most of them are medium or low risk, then I'm probably able to accept a handful that are high risk. So you really want to be balancing that risk portfolio and making sure you don't have all your clients in that high risk category. So if somebody's high risk, it doesn't mean that they'll never be able to find a new auditor. They just need to find a new auditor that can accept that level of risk in relation to the rest of their risk portfolio. Also want to understand if there's any significant internal control weaknesses or problems. We'll talk more in chapter 6 and 7 about what exactly the significant deficiencies and material weaknesses are, but basically it means there's issues with internal control. And you also want to get the old auditors understanding of why the client is changing auditors, right? Because it could be something relatively neutral or okay, like they thought the old auditor didn't have sufficient industry expertise. And so they want to move to an auditor that is an industry expert, right? That's kind of a normal reason for moving that wouldn't cause a lot of alarm. But if the reason is, well, we're constantly fighting with management because they want to be really aggressive with their accounting policies, well, that says to me, hey, this is a high-risk client, and maybe this is someone I don't want to accept. When public companies transition from an old auditor to a new auditor, they actually have to file a press release or an 8K filing with the SEC. And they have to explain what the change is, why the change is happening, and so on. So this basically has to be disclosed to shareholders. This is basically an effort to keep things transparent so that companies just can't go around switching auditors constantly to kind of shop for the audit opinion they want. And you'll notice in the Form 8K, not only do we have a kind of press release from the client explaining the change, but we also have a response from the auditor saying, do you agree or disagree with what the client is disclosing, what your old client is disclosing? So I have an example here from Delta Airlines. Okay, so we see here, this is an example 8K from Delta Airlines that they filed in January of 2006 when they switched auditors. Okay, and you'll notice they switched from Deloitte to Ernst & Young. So this first paragraph here is just explaining that they've decided to switch from Deloitte to EY. This paragraph here is just summarizing the last couple of audit opinions they've gotten from Deloitte to be clear that those audit opinions were not adverse or disclaimers. They do note that these last couple of years, the opinion from Deloitte did include an explanatory paragraph saying that they're worried about Delta's ability to continue as a going concern, right? So we know from our studies of the audit opinions that this is technically an unqualified opinion with an explanatory paragraph. So it's not saying there's anything wrong with their financial statements, but it is saying Deloitte thinks there's a good chance that Delta goes bankrupt within the next couple of years. And oftentimes, if you issue going concern opinions, if you read that article I posted, you'll notice that they're kind of considered a self-fulfilling prophecy. And so most clients absolutely do not want a going concern opinion, and they consider it to be a bad opinion. And so oftentimes what you'll see is after you get a going concern opinion, that client will fire its auditor and take on a new auditor, right? Because there's basically sort of bad blood involved with the issuance of these going concern opinions. So this paragraph just says, hey, we didn't have, this third paragraph is just saying there was no significant disagreements with Deloitte over the years. And this is saying Deloitte has also given a letter to confirm this, and it's attached. This fifth paragraph is quite interesting because if you read it, basically they're saying, hey, during those fiscal years, 2003 and 2004, we didn't go opinion shopping. So we didn't say, hey, Deloitte's giving us a going concern. I want to talk to EY and see if they would have just given us a standard unqualified opinion with no mention of going concern. Right? So this is kind of to cover their butts and say that they were not opinion shopping and they're not transitioning to EY because EY promises not to give them any more going concern opinions. And now here we see Deloitte's letter, right? Just like we said on the slides, the old audit firm has to issue a letter in response to whatever the company is disclosing over here. So we see Deloitte issued this letter. They said, hey, we've read Delta's disclosure and have the following comments. We agree with the statements made in paragraphs 1 through 4, these. And number 2, we have no basis on which to agree or disagree with the statements made in the 5th paragraph. Now remember, the 5th paragraph is where Delta was saying, we didn't go opinion shopping with EY to make sure they won't give us a going concern opinion. Deloitte is just saying, we don't know if they talked to EY or not. It's almost like this is a disclaimer of what they're saying in their 5th paragraph, right? We have no basis to agree with it. We have no basis to disagree with it. So there you have it. Okay, so going back to our slides, that's it for that, for client acceptance. Now let's talk about continuing client retention decisions. Every auditor will reevaluate this periodically. Generally, you'll reevaluate it every year. After you've just completed last year's audit, you'll reevaluate and say, hey, do I want to keep this client for next year's audit? If you've had lots of conflicts with the client, if you're constantly arguing over fees and you don't think you're getting paid enough, then that might be a reason to kind of fire that client and move on. I would say this again it's fairly unusual. Most of the time the auditor will be willing to take that client on for another year. And again, it's going to be a kind of risk-based decision, which is what we have here on this slide. It's saying, hey, these are reasons why you might have auditor turnover. And again, it's basically all these, you have to weigh and consider all these different types of risk and determine if that client kind of fits into your overall risk portfolio. So that's what these first 3 are getting at. And read through them. They are similar to what we talked about earlier. And another reason could be you're simply misaligned with your client. So again, this could be like the case of the client really wants an expert in my industry. And so I'm going to move on to a new auditor that does have that industry expertise. It could also be like you have a small startup firm and it has kind of grown exponentially in the first few years of its life. And they used to just have a small auditor where they were, that had 5 clients. And that was fine back when they were not a public company. But now they're becoming a public company. They're growing. They're opening offices all around the United States. And that type of big business really should be audited by a Big 4 audit firm, right? Only a Big 4 audit firm is going to have the capacity to send staff to all their locations around the nation to perform audit procedures there.